Well, Jeff, thank you for coming on the Advisor Lab. We really appreciate it. I know you've been very visible, with the 2026 underway, looking and talking about productivity trends and just the Fed Balancing Act, and for advisors just managing client portfolios. What's the single most important macro theme that they should be focused on right now as we kick off the new year?
I think advisors need to be reminded their job is not to trade the headlines. I think case closed. That's probably the best thing to educate their client base, saying, look, this is about longer term trends in the marketplace, how the economy is, where is the US relative to the rest of the world, looking at these movements that are both cyclical and structural, but at the end of the day, reminding the client we are not here to trade headlines. And of course, referring to the current political landscape, I don't know, in the course of my career, I don't know if we've ever had so many headlines in such short periods of time.
Yeah, it's something like we've never seen. And I've been in the market now over 25 years as well. I started as an FA at Merrill Lynch back right before the internet bubble. I got there in '99, and kind of 6 months in, we saw the pop in March 2000. And yeah, you're right. Because of the social media platforms and the 24-hour a day cable and everything else, and the clickbaiting, right? So you make a great point, though, and I want to talk a little bit about, the labor and market and what you're seeing in terms of productivity trends and things like that. But when you say to folks, well, you don't want to trade the headlines, right? But you have a massive amount of population that are boomers, that are in retirement, that probably benefited as much as anyone, right, from this massive bull run that we've had recently and really throughout their lives. The perfect world, right? You had a bond bull market, you had an equity bull market, really going back to '87. But folks who are more like me, 53, 54, they need to start thinking about capital preservation, but they still want growth. And there's, fears and clickbaiting. Just looked at something from, I think it was Michael Berry, called The Big Short, right? Like we are in a bubble. We're in an AI bubble. This is massive. This is, maybe like the internet bubble. I guess my question is, they could lose 40% of their portfolios tomorrow, and it could take a decade for them to make it up. Like, what do you say to advisors? Like, those people, do they need to think about some of the real fundamental factors? Like, equities are expensive by any measure. Like, how do you think about that?
I think it's helpful to remember there are some structural changes going on, and I'm not sure if certain aspects of the AI story are at the euphoric bubble level. One of the things that I like looking at is utilization rates by industry, and that helps me determine, is this a fad? Is this something that's going to shift, in the near term after the fad is gone, like Beanie Babies or Cabbage Patch dolls? And you look at some of these industries that are very labor intensive, and utilization for AI is not that high quite yet. Think about leisure hospitality. Think about that's the hotels, restaurant industry. And one of the things that a couple of private sector companies do, and they track among thousands and thousands of companies, what kind of utilization subscription packages, what's the corporate view on AI and how those tools could hypothetically help their labor force. And that's where I see, in addition to leisure and hospitality, I see other industries that still have very low utilization rates that could benefit from uh, lower AI usage. Healthcare services, for example, not quite there, not quite as high as maybe financial services. And so I think there's a little bit more room to go. Now, perhaps some aspects of the AI story might be you're really at very, very high lows. But I think there's more room to go. I think again, going back to some of the other structural changes that's helpful for advisors to educate their clients is that, COVID and its impact has, I think, fundamentally changed so much of how the economy operates. That's one of the reasons why 2024, 25, even 2026 in our forecasts, things look pretty good. It was interesting, back in the day when Fed was starting to hike rates soon after 2021, coming out of the pandemic, we all were worried, okay, is the Fed going to break something? Well, what happened was there were so many millions of Americans that were able to cut down on housing costs. There were so many millions that moved from higher cost of living areas to lower cost of living areas that there were just a lot of households that had healthy balance sheets. As we age, as the economy ages, we're less and less interest rate sensitive. And so Fed could get through a complete rate hiking cycle and nothing broke. And that was a little bit of a surprise. I think, I will speak for myself. I didn't realize how much that geographic reshuffling that happened in 2021 would have such a long-term impact. I think we're still feeling that impact. Look at the demand for travel, look at the demand for discretionary items, the difference between that K-shaped economy, the upper part of the K versus the lower part of the K. I think a lot of that was the structural change that we saw post-COVID. I think that's very, very helpful to understand. Okay, there's more room to go. After 3 years of a bull market, is there more room to go, even though valuations are hot? I think the answer is yes, because growth looks pretty decent. The high frequency numbers on labor market stress, pretty low stress. And now, granted, it's a low hire environment, but there's low firing and low stress. You see that particularly in the weekly unemployment insurance claims that comes out Thursday morning. So there are a lot of structural changes that I think advisors have to explain and educate their client base.
So to kind of summarize this utilization rate aspect that you brought up, basically, are you saying these industries and companies just haven't even really begun to really maximize the potential productivity benefits from AI? Now, yes, we're seeing sort of the valuations of equities and companies, generally speaking, maybe getting ahead of themselves a little bit in anticipation of those productivity gains. But this is a much better scenario than, oh, well, yeah, you know what? They're at 60% utilization. I think they've kind of maximized what we're going to see for the next 5 to 6 years, and they're already being marked as if, right, like the productivity gains are built in. So you see, like, because a lot of what you read about is, well, we're not really seeing the benefits yet. We haven't really seen the profits yet, the real earnings, what should drive stock prices, right? At the end of the day, all this money that's being spent that is going to be invested by the big behemoth techs and so on. It's not really translating yet. Like as a chief economist, like how do you time bank that? Like not time bank, but time frame. Like when should we see it? Like do you look at like the internet was the last big technology revolution? When did we really see the gains? Sort of like the Amazons grow into the earnings kind of thing. Like you have some sort of way you're thinking about that from a time construct?
Yeah, it's a great question because I think we can say definitively that the time between all this build out of the framework until we actually see real productivity enhancements, I think that time is going to be a lot shorter. That gap between the money put in and the money saved, shorter time frame than what we saw in the late 90s because we were building out so much of the framework in understanding yes, businesses are moving away from paper, hard copies to soft copies. It was 2, 3. Some people think up to 5 years where there was definitive numbers to show, like, hey, this really worked. I don't think it's going to be that long. but it's not going to be instantaneous either. I think that's where it's real helpful to remember this is not an instantaneous thing. Yes, there's a lot of money being built out right now for the framework, and it'll take some time, but not as slow. I'd say 2027. Give it 12, 18 months.
Mhm.
You'll start to see some improvements. You think about, I told you the numbers on healthcare and social assistance and combination food services. So I'm looking at the numbers right in front of me right now. End of the year utilization rates for that leisure and hospitality, 22% utilization rate across the sector. A lot more to go. So mining, oil extraction, things like that, 32% utilization rate. Healthcare, 30.9% utilization rate. Now, granted, technical services, finance, insurance, utilities, information sector, a lot higher utilizations. So I think give it 12, 18 months. I think that's the short answer of it.
Let's talk about the labor market in relation to this. So we keep hearing about softening labor market, but job creation is positive and wage growth remains decent. And like, it sounds like you're characterizing the health of the labor market fairly decent. Like it's pretty good. Now, this AI phenomenon, how does that like play into your sort of forecasting with labor, right? Because there's obviously a narrative around a lot of people are going to lose jobs and be out of work and get replaced. But of course, there's also a massive amount of infrastructure that has to be built. And that obviously can create jobs and positives for the economy. And then there's just the whole, what this AI business looks like for the economy. And is there a lot of compliance nightmares? Does it create friction and bureaucracy? The government hasn't really, it seems, been too outspoken about how they're thinking about kind of managing this or regulating it. And so that can either help or hurt growth. How do you see it from an economist standpoint in terms of the labor market as you look out maybe 18 to 36 months?
Well, I think the best way to look at it is, what has happened when new technologies, hit. Now, granted, this is pretty dramatic, but how does the labor market respond? I would say from a policy standpoint, first and foremost, you gotta see a flexible labor market. We don't want to have a labor market like Japan, lifelong occupations, lifelong positions. You want to see flexibility because you have to have a flexible labor market to adapt to these new technologies. I think also from a policy standpoint, I think the government's doing the right thing in saying, hey, look, it's too early to even have a good handle on how to regulate some of this stuff. We have to wait till the dust settles a little bit. I think that's the right approach. In terms of how it will impact the labor market, one of my colleagues who's at MIT has given the stat that I think is quite compelling. He said, look, 60% of jobs today didn't exist. That job title didn't exist when your grandparents were around, a couple generations ago. In essence, trying to illustrate the fact that there's not a substitute for human touch, human interaction, the relational component uh, of what we do. I think the advancements technologically to make us more productive is exactly what we need when we're also worried about a shrinking labor force. And
Hmm.
so, in some ways, this comes at the right time. It's not too soon to have these tools that seem to tell us, hey, productivity could really spike to the upside. That's fantastic. We're living longer and we're having a shrinking labor force, population growth in general slowing. That means fewer numbers of workers supporting larger numbers of folks outside the labor force, retired, have to have some technological boost. I think this might actually be that perfect elixir to give us the productivity boost that we need.
So that's a good segue to talking about the Fed and how you know, the monetary policy uh, conversation right now, right? I think you said at one of your interviews, There's no risk-free path for monetary policy. Um, what would you say the real risk the Fed is managing right now?
Well, a lot of uncertainty around trade policy that'll affect the inflation side. A lot of uncertainty about, how long this CapEx investment for data centers, AI will last. That's on the growth side. And so they're really walking this tightrope. I think one of the things that Chair Powell has suggested is, we could see continued above trend growth and inflation easing up, but it really has to come along with just a more efficient labor force. So, they're banking on a productivity enhancement in 2026. I think it's possible that we are in a scenario where if we work on the supply side of the economy, we can actually have, above 2% growth. We're expecting 2.5% growth in 2026. That's above trend. That's still very, very good growth. And at the same time, have inflation ease up a little bit because we're addressing the issues from the supply side. I definitely have preferences toward some of the Art Laffer, uh, the, the the guys in the 80s
Yeah.
talking about the value of supply side economics. I think when you see things like that happening, that will give you the tools and kind of the framework for a pretty decent investing environment. Growth, growth pretty solid, inflation well under control. That's definitely a recipe for a risk on.
So if you had to sketch a base case a year from now, where do you think rates will be?
I think we're approaching the 3 to 3.25 range uh, a year from now. Of course, we're recording here when Davos is in full swing. I'm sure your listeners will know what I'm referring to, World Economic Forum. Uh,
Yeah.
And so, I think you think about where the uncertainty is on the global scale. I think it's possible for real rates to be, say, 1.25. So inflation's approaching 2. It's going to take some time to get to 2, but I think by the end of 2026, my forecast is that we'll see core PCE around 2.3%.
Mhm.
If Fed's rates, nominal rates, are 100 basis points above that, that's a pretty comfortable scenario. As we all know, when the Fed is easing up on policy and there's no recession, that's that's a good signal for risk assets.
Yeah, Jeff, that doesn't concern you a little though. This economy's doing fine. I mean, inflation seems to be getting controlled, but there's still, it's expensive out there. I bought a dozen eggs for $9 the other day. But you've also got the one big beautiful bill, right? That's going to be stimulative to the economy. Um, and the market's been hot as all get out. People are up 40-50% from COVID on the real estate assets. The mortgage rate finally, I guess, dipped below the 6 handle recently. And like you said, like things are pretty good. Um, but there's no concern from your perspective long term about inflation reigniting. And of course, this could change tomorrow, but we got a whole slew of new tariffs coming. I'm curious on your perspective on that, but obviously a lot of folks kind of got it wrong with Liberation Day, although Trump did walk back a lot of the like intensity of his tariffs, so maybe they didn't get it that wrong. But I guess it just put a bow on that, like from that perspective.
A lot there. I was on a Barron's roundtable last year, and I was highlighting the importance of looking at Trump 1.0. We had massive tariffs on China. It was not inflationary. Now, granted, Trump 2.0 is a little bit different because the tariff policy was a lot more exhaustive, including so many different countries, really upending a lot of the trade policy. But I think, one of the most important data points that I tracked recently and will track continually in 2026 is some of the specific comments from business owners in all of the 12 districts of the Federal Reserve System. course, referring to the Beige Book.
Hmm.
In recent Beige Book editions, firms continue to say, and this is pretty much across all industries, across all 12 districts, that they're a little bit cautious in passing along the cost of a tariff to the consumers because they want to protect their market share. So they know, there's a K-shaped economy. Yes, the upper incomes are doing great. They are saving a lot of money from the refinancing that they did in 2021. And so, it's like an extra $250 bonus every month because of the refinancing. And so consumption is on the upper side of things. The demand's still pretty strong, but you got to worry about the middle and the lower income folks. And so businesses are telling us they're not passing along those costs as much. They're adjusting supply chains. They started adjusting supply chains right after COVID. So in essence, a tariff hit was done after businesses were adjusting post pandemic. Interestingly enough, just a little bit of an aside here, if we had a Trump 2.0 type of trade policy pre-COVID, I
Hmm.
think it would have been a lot worse because businesses hadn't had the shock of the pandemic yet. They hadn't had this massive incentive to reassess the vulnerabilities of supply chains. But since Trump 2.0 was after a pandemic, the economy has handled it. Our view and what we wrote last year in the mid-year of last year, plus as we were preparing for 2026 outlook, we were saying, look, if the effective average tariff rate hovers around 10 to 15%, the economy can handle that. Now, granted, it is a headwind, but it's manageable. And indeed, that's where we are. We're in the 10 to 13% average effective tariff rate as of the end of last year, and that's pretty decent. In terms of the inflation side of things, going back to your earlier comment, hey, we got above trend growth. Aren't we worried about inflation reigniting? I think that's why it goes back to where the stimulative policies are going to hit. Are they going to hit on the supply side of the economy or the demand side? Meaning, are these stimulus checks going out to everybody so they can all go upgrade their, high definition TVs? Or is it stimulative because we're talking about bonus depreciation? I think in this case, it's the latter. And hence, if you have a supply side component to the stimulus, you really, I think, can work on the production side. Hence, you can have above trend growth without inflation getting out of control. But a lot of things have to work out in the right way, and it's a little bit fragile, shall I say.
Yeah. When you think about the asset allocation strategy into 2026 and the markets, obviously, as you mentioned, equities keep grinding higher. Um, do you think there's anything investors are underestimating right now as they continue to put capital towards equities?
I think it's fair to say, again, we're recording here, mid-January. I think investors need to be careful overreacting from this sell America
Mm.
trade that's made headlines in the last, couple days. I think when you look at the fundamental underpinnings of the economy in the U.S. relative to other G10, really G20 countries, productivity is much stronger in the U.S. When I think productivity, the very basic, when you want to think about explaining it to end clients, it's how much can we produce per hour worked. So wages are important relative to what we're producing. Productivity is very strong in the U.S. relative to other countries. I think the structure of property rights, the stability of a legal system, ownership, the ability to protect your creation, as it were. People come to the U.S. to innovate. Patent trademark laws are extremely important. So I think we got to be careful against this overreaction on hey, let's get at it. U.S. exposure. Let's look elsewhere. I think when you think about risk adjusted frameworks, I think a domestic bias is still warranted even for 2026.
So big picture 2026, what do you think the economy looks like? What's your kind of base case?
Well, I think we still have a K-shaped economy.
Yep.
That's still gonna still be the case. I think you still have your upper income consumers doing pretty well. Lower income, that's a different story. I do think we'll get a little bit of a recovery in the housing market as rates go down. And, that was one of the key themes for 2026 outlook, by the way, just, behind the scenes here. We're writing this outlook in October, November. And of
Right.
course, thinking about 2024, just before the election, thinking, wow, there could be so many different scenarios. In fact, I know a lot of other shops. I think Goldman, for example, pushed their outlook a little bit later because you had a very, uh, potentially historic election going on. Then on top of that, you lost a lot of data because the lapse of government appropriations. So you didn't have official public data on some things going into, when we were writing, November, early December. Hence, there was a lot of things that were uncertain. But in October, we were writing 2026 is going to be a year where mortgage rates are going to fall. Well, that's going to ease up some of the clogging in the housing system. And indeed, so far, now granted, only a couple of weeks into the new year, but I think we can continue to expect 2026 where rates are going to be lower. That's going to ease up a little pressure in the housing market. I think from the business side of things, I think there's still going to be a little bit of pressure on margins because businesses are going to want to protect their market share amid some cost pressures from trade policy and just the uncertainty of all that. So that's going to be a theme, I think, in 2026 where margins are going to be uh, under pressure. And then in terms of labor market, I think we will see an unemployment rate approach 4.7. So we've been very, very low. We've been in the upper threes for a while, right? Chair Powell was really, really nervous about a tight labor market. We didn't have enough people looking for work for the number of openings. Remember 2022, 2023, businesses were saying, hey, one of our top challenges right now are finding qualified workers. I
Hmm.
think that's going to be very different in 2026. I think there will be a lot less tight labor market, even though the demand for labor is going to be a lot softer 2026. That's going to be a theme, I think, as well. In terms of international story, I think in 2026 it's continue to be an uncertain big gold question mark on Japan. Japan's trying to deal with their ultra low accommodative policy. They're trying to reverse some of that. The growth story is not terribly strong. Japan matters because it's a big weight in IFA, and so that's very, very important. So very, very weak yen. Bank of Japan is really struggling knowing what to do. So a little bit of risk there. From a China standpoint, residential real estates continue to weaken, I think, in 2026, even though it really has weakened the last couple of years. I think there's still more to go to the downside in residential real estate, particularly in the China markets. And then the uncertainty about Taiwan. We rely so much on the production of semiconductors out of Taiwan. And I think 2026 will continue to be another year where we're carefully watching the geopolitics and the risks there of China adding a little more pressure on Taiwan. That's certainly going to play into the international trade story, if indeed that goes not how we would want it to go.
That's a great summary of your outlook. I'd like to finish with this question. If you're an advisor today and you're running a billion-dollar practice, call it, um, how should they be positioning their portfolio over the next 3 years?
Well, I think it's helpful for advisors to think alts need to play a bigger uh, piece of the pie, get a bigger slice of the pie than perhaps in previous cycles. I think within that alt space, think about commodities. I think commodities, particularly the precious metals, that's obviously gotten a lot of press the last several months. I think that's here to stay. I do think it's helpful for advisors to explain to end clients. I don't think the US dollar is going to lose its reserve currency status in this generation.
Hmm.
You know, maybe our grandkids might see something more dramatic. But I think in terms of the next 10 years, 5, 10 years, I don't think that that's a risk that needs to play into the allocation process. And finally, in addition to alts, commodities, and dollar type of conversation, I still think there's still a benefit to be a domestic bias given the stability, overall stability that we have in this country relative to other countries, particularly emerging markets.
Right. Um, yeah, private markets, real assets. That's interesting. And I mean, obviously inflation's coming down, but there's still some structural forces that aren't necessarily going away tomorrow. Um, Within that, do you look at infrastructure, private credit? Obviously, there's private equity. There's so much innovation and 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 product development across the board in the private wealth channel now. Do you think it's just a good idea to just incorporate private markets generally over the next 3 years, or you have specific areas within the private market universe that you would suggest or think about more closely?
Yeah, I think there's such a development still going on, particularly taking product to the advisor that has exposure to some of these. So I think I would put it in that way.
Mhm. All right. Well, this has been great. I have one final thought or question, and I think you might have answered it at the open, so that's okay. But um, could you give advisors advice, one piece of advice, if you were to give them kind of as they negotiate the market cycle, um, what would it be?
Well, I think as I mentioned in the beginning, be careful about being whipsawed by the headlines. Develop uh, a course of action, stick with that course of action, be mindful of structural shifts, but typically structural shifts don't happen overnight. And so that's helpful not to have knee-jerk reactions, particularly in a headline-driven market that we're in right now.
Well, Jeff, thank you. This was great. I'm sure the listeners really enjoyed it, and we certainly look forward to obviously seeing how 2026 develops. And we hope to have you back on the show soon. So we wish you a great year. Thank you.
Thank you.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.